It's Tuesday morning. You open your eyes, reach for your phone the way you always do, and pull up your bank account to check on things like you do at the start of every month. But this time, something stops you cold. Your Social Security payment is not there. Your chest tightens instantly. You check the screen a second time, then a third. Where is it? Where did my money go? I am living on a fixed income. I do not have a cushion to fall back on. What has happened to my benefits? If that scenario sent a chill through you, you need to understand that you are far from alone. Thousands of older Americans are experiencing exactly that kind of panic in 2026. And the cause behind it is a regulation that most of them had no idea even existed.
My name is John, and I work as a senior policy analyst with a specialization in retirement finance and Social Security regulations. For more than a decade, I have dedicated my career to helping retirees, just like you, cut through the complexity of the policies that directly impact your financial security. Today, I am going to lay out precisely what this rule is, walk you through the official government materials that define it, and give you 3 specific steps you can take right now to keep your benefits protected. But I need to ask you to stay with me all the way to the end of this video, because I am going to reveal a hidden error, one that thousands of seniors repeat every single month, that can result in $1,000, $2,000, or even $5,000 or more in withheld benefits. The majority of people have no awareness of this mistake, and by the time it surfaces, the damage is already done. Let me introduce you to Robert. Robert is 62 years old. He has spent his entire adult life working. For 4 full decades, he faithfully paid into the Social Security system. In 2026, Robert decides the time has finally arrived. He retires. He is exhausted, and he has earned every bit of this rest. Social Security approves his application, and his first monthly payment arrives, for $200 per month. It is not a lavish amount, but combined with his savings, it is enough to live a modest and reasonably comfortable life. But things do not unfold the way Robert anticipated. His savings begin draining faster than he projected. His roof develops serious problems that require repairs. His car breaks down at the worst possible moment. Medical expenses start accumulating one after another. Just 3 months into retirement, Robert's phone rings. It is his son. "Dad," his son says, "I know you just retired, but my company is looking to bring someone on. They need a person with your background and experience. It would be part-time, flexible scheduling, you pick your own hours." Robert turns it over in his mind. Part-time work. That could genuinely help ease the financial pressure. I would only be working 10 or 15 hours a week. Maybe I bring in around $20,000 for the year. That is not a significant amount. And besides, I heard Social Security only starts cutting your benefits if you are pulling in serious money. So Robert accepts the position. But here is what Robert had no way of knowing. His earnings are not going to land at $20,000. Because his son's company runs consistent overtime, and Robert takes it, he needs to rebuild his financial cushion. His actual earnings for the year are going to reach $30,000. And in 2026, if you are collecting Social Security before reaching your full retirement age and your earnings exceed $24,280, Social Security does not simply trim your benefits by a small amount. They suspend them entirely. When Robert opens his banking app the following month, that $200 deposit is nowhere to be found. He calls the Social Security Administration, completely confused and deeply unsettled. The representative on the other end delivers the news calmly. His benefits have been suspended because his earnings exceeded the allowable threshold. They are withholding his payments through the remainder of the year. Robert's hands begin to tremble. Suspended? For how long? When exactly will I receive my money again? The representative responds that the agency is still calculating the total amount he received beyond what he was entitled to. Robert sits there realizing with full weight what has happened. He made a serious miscalculation, and now he has no idea how to get himself out of it. June. This is happening to real people in real numbers right now. And the most unsettling part is that many of them cannot even explain why it happened. So let me break down the exact rule that caught Robert completely off guard. The rule carries the name the Retirement Earnings Test, also referred to as the RET. It is a federal statute that has been part of the law for decades. This is what it does. If you begin collecting Social Security before reaching your full retirement age and you continue working while receiving those benefits, the Social Security Administration will automatically reduce your payments if your earned income crosses a defined threshold. For 2026, those thresholds are clearly established. If you are under full retirement age for the entirety of the calendar year, your annual earnings limit is $24,280. Broken down, that comes to approximately $2,040 per month. The moment your earnings reach $24,280, just $1 above the ceiling, Social Security begins determining how much of your benefit to hold back. Here is the specific math that catches people completely unprepared. For every $2 you earn above the annual limit, Social Security withholds $1 from your benefits. Let us use Robert's situation to make this concrete. Robert earned $30,000 during 2026. The limit sits at $24,280. His earnings exceeded that ceiling by $5,720. Social Security then applies the formula. $5,720 divided by 2 equals $2,860. That means Robert forfeits $2,860 in Social Security benefits for the year. With a monthly benefit of $1 and $200, that translates to roughly 2.3 months of payments withheld in their entirety. Now there is something critically important to understand here. Specifically, what the Social Security Administration counts as earnings and what it does not. Income that counts toward the limit includes wages earned from an employer and net self-employment income if you operate your own business. Income that does not count includes investment returns and stock dividends, interest accumulating in your savings account, pension distributions, annuity payments, capital gains from asset sales, veterans benefits, other government retirement income, and unemployment insurance payments. This distinction matters enormously. Many seniors genuinely underestimate their countable earnings because they mentally blend all of their income sources together. They might think, I have $5,000 coming in from a savings account, so my earnings must be lower than I thought. But that interest is completely irrelevant to the calculation. Only wages and self-employment income factor into the earnings test. There is one additional provision worth understanding. If the calendar year in which you reach your full retirement age happens to still be in progress, a different and somewhat more forgiving threshold applies. For the months of that year before you actually reach your full retirement age birthday, the limit rises to $65,460, and the withholding formula becomes less severe, $1 withheld for every $3 you earn above the limit rather than every 2. And here is genuinely encouraging news buried within all of this. The moment you reach your full retirement age, the earnings test vanishes completely. From that birthday forward, you can earn any amount of income you choose, from any number of jobs, and your Social Security benefit will not be reduced by a single penny. But until that birthday arrives, every provision of this rule remains fully active and fully enforced. Let me now walk you through a specific provision that has the potential to help certain retirees navigate this rule more effectively. It is called the Special Rule for the First Year of Retirement. Here is the situation it addresses. If you retire partway through the calendar year and you have already accumulated substantial earnings in the months before stepping away from work, there is a monthly earnings calculation that can work in your favor. In any complete month during which your wages total $2,040 or less, you are entitled to receive your full Social Security benefit, even if your total earnings for the entire year have already blown past the annual limit. Consider this scenario. You retire on October 30th, having already earned $45,000 during the year. In November and December, you pick up a part-time position that brings in $500 each month. Despite the fact that your yearly earnings exceeded the annual threshold by a wide margin, you will still receive your complete Social Security payment for both November and December, because your actual earnings in each of those individual months stayed under $2,040. This provision gives certain retirees a meaningful degree of breathing room that they might not otherwise have access to. For those who are self-employed, a comparable rule applies. You are treated as retired in any month during which you work fewer than 15 hours. Now, here is the specific failure point that trapped Robert and that continues to trap people in his situation every single year. You are legally required to report your earnings to the Social Security Administration, and you need to do it promptly. When you first file for benefits, you provide an estimate of what you expect to earn for the year. But if your actual income turns out to be meaningfully different from that original estimate, higher or lower, you must contact Social Security without delay. The direct number to call is 1-800-772-1213. That is the main Social Security Administration line. If you allow the discrepancy to go unreported, the agency will eventually uncover it on their own, typically through your W-2 filing or data submitted directly by your employer. When that happens, the SSA will determine that you received more in benefits than you were entitled to receive. That excess becomes classified as an overpayment, and you will be required to pay it back. That is a stressful situation that is entirely avoidable with a simple phone call. But before the weight of all this sends you spiraling into the kind of fear Robert experienced, there is something absolutely critical I need to share with you, something that changes the entire picture. When you reach your full retirement age, every dollar of benefits that was withheld under the earnings test is permanently credited back to your monthly payment. Let me repeat that because it is genuinely that important. Withheld benefits are not gone. This is official, documented Social Security Administration policy. It operates under the name Adjustment of Reduction Factors, or ARF. Here is how it functions in practice. Suppose you claimed your benefits at age 62 with a base monthly payment of $1,000. Over the next 5 years, while you continued working, the earnings test caused some of your benefits to be withheld in various years. When you reach your full retirement age at 67, the Social Security Administration conducts a full recalculation of your benefit. Rather than counting the full 60 months of early claiming against you, they adjust the calculation to reflect only the months during which you actually received benefits. This permanently raises your monthly payment for the remainder of your life. And if the income you earned during your working years happened to exceed some of your earlier earning years in Social Security's records, the agency will also recalculate your benefit upward to reflect that stronger earnings history. So Robert's story does not end in financial ruin. Here is what the complete picture actually looks like. Robert experiences the pain of having several months of benefits withheld during 2026. That is genuinely difficult, and the disruption to his monthly budget is real. But when Robert reaches his full retirement age at 67, Social Security revisits the entire calculation. His monthly payment increases permanently. Those months that were withheld were never truly taken from him. They were converted into a higher lifetime benefit that he will collect for every remaining year of his life. When you account for that additional monthly income over a normal retirement lifespan, Robert actually comes out ahead of where he would have been had the withholding never occurred. This is exactly why understanding the complete picture of this rule matters so much. It is not a permanent financial penalty. It is a temporary disruption, one that is manageable if you know the right steps to take. So if you are currently working during retirement or seriously considering it, here are the 3 precise steps you need to take right now to protect your benefits from unnecessary disruption. Before you sign any employment agreement or agree to take on additional hours, sit down and do a real calculation. How much money will I genuinely earn this year? Do not estimate on the low side because it feels more comfortable. Work out the actual realistic number. Keep the 2026 threshold firmly in mind. $24,280 if you are under full retirement age for the entire year. If there is any realistic possibility that your earnings could cross that line, your next move is to pick up the phone and call Social Security today. Dial 1-800-772-1213. Tell the representative what you expect to earn. Ask them to walk you through exactly how your benefits would be affected. This call costs you nothing. It takes roughly 15 minutes of your time. And if your income changes at any point during the year, whether it goes up or comes down, call them again right away. The goal is to be the one who tells Social Security what is happening with your earnings rather than letting them discover it through your tax documents after the fact. When it comes to understanding what counts toward the limit, keep it simple. Wages from an employer count. Net self-employment income counts. Investment earnings, interest, pension distributions, and annuity payments do not count. If you are uncertain whether a particular income source falls under the earnings test, ask the Social Security representative directly when you call. Do not assume and do not guess. The stakes are too high for that. Beyond managing the reporting itself, build a habit of keeping thorough records. Hold on to all of your pay stubs. Preserve every W-2 form. Keep your 1099 documents if you work for yourself. Maintain copies of every piece of correspondence you exchange with Social Security. Save your benefit statements. Hold on to banking records that document each deposit you receive. If the SSA ever raises a question about your earnings, your documentation is your protection. If a discrepancy arises that requires an appeal, your records are your evidence. And if a genuine error occurred, you have a window of 3 years, 3 months, and 15 days from the year in question to seek a correction. I recognize that everything I have just walked you through sounds overwhelming. Robert's experience probably stirred up some genuine anxiety. But I want you to hold on to something important as you absorb all of this. This rule is not designed to permanently strip away what you have earned. It affects people temporarily, and for the vast majority of retirees who encounter it, the long-term outcome is not as damaging as the initial shock suggests. I have had countless seniors tell me over the years that learning about the credit-back provision changed everything for them emotionally. When I found out that what was withheld would actually come back to me at a higher monthly rate once I hit full retirement age, one woman told me, I finally stopped losing sleep over it. It was never a loss, it was just delayed. If you are sitting with worry right now because you are working and you think your earnings may be approaching or exceeding the limit, do not sit in that anxiety without taking action. Call Social Security. Report your numbers. Find out precisely how your benefits will be adjusted. Understanding your specific situation is 1,000 times better than uncertainty. The most damaging thing you can do is push this aside and wait for it to resolve on its own. It will not resolve on its own. It will compound. The most protective thing you can do is make that phone call today. Social Security regulations are genuinely complicated. They are adjusted on an annual basis, and the cost of not understanding them can add up to thousands of dollars in benefits that you should have kept. Relying solely on occasional YouTube videos to stay informed is simply not a reliable enough strategy for something this consequential to your financial well-being. You need a dependable, ongoing source of information. You need real-time updates delivered directly to you. You need access to official guidance when policies shift. That is exactly why I want to personally invite you to join the Global Senior Alerts official WhatsApp channel. There is no cost to join. There are no advertisements. There is nothing being sold. It is a straightforward, verified information resource dedicated exclusively to Social Security updates, pension changes, Medicare developments, banking regulations, insurance policies, and travel rules that affect seniors. As a member of the channel, you will receive a free downloadable Senior Benefits Protection Guide that translates every regulation we have covered today into plain, clear language with printable checklists you can keep on hand. You will also receive real-time alerts the moment Social Security adjusts its rules, Medicare coverage shifts, or any new policy emerges that could affect your monthly income. And every piece of information comes with links to official government sources, so you always know you are working from verified facts. The link to join is waiting for you in the description section below this video. Click it right now. Download your free guide. Do not wait until you are sitting there on a Tuesday morning staring at a bank account that shows no deposit. Do not wait until the fear Robert felt becomes your fear. Take action before that moment arrives. Your retirement security is not a secondary concern. Your peace of mind is not a luxury. You worked for decades to reach this chapter of your life, and you deserve to understand every rule that governs your benefits so you can protect what is rightfully yours. Thank you so much for spending this time with me today. I am John, and I will see you in the very next video, where we are going to dig into the 2026 Medicare premium increase that is quietly eating into your Social Security cost of living adjustment before you even see the money. Make sure you hit that subscribe button right now so you do not miss it. Take good care of yourself, and I will talk to you soon.